Good morning, everyone. Good morning, Rajesh.
Good morning, sir.
Good morning, Dipansh.
Go ahead.
Good morning, everyone. Welcome to Startup Change Leaders weekly meeting. We have a community where we meet every week and we try and discuss the various facets of startup ecosystem. Last week we had Juan from Singapore, and we also discussed about what are the opportunities of working with Singapore, and what is the implication of connecting the Singapore's payment system with Indian UPI. So, the world is changing very fast, and the startup world is also changing, and we are improving as a country in the startup ecosystem very rapidly. And very soon we are going to be number 2 startup ecosystem of the world, and definitely we'll be number 1 someday. So it's very important to understand what are the terms being used by VCs and angel investors across the world. And since Indian startups are going global, and there's a lot of traction which is coming to India, and looking at the overall state of Indian economy, we know that India is rearing to be a number 3 economy of the world. So from that perspective, we are all working towards making the ecosystem more vibrant, spreading the knowledge to all the startup entrepreneurs and the aspirants, the youngsters who are, uh, daring to understand what this startup world is all about. And I have seen a lot of change in because I keep visiting various universities and colleges. The students have a lot of enthusiasm of starting their own uh, entrepreneurial journey, and they are looking to launching their own startup. So more and more people are getting into this system, and it is very important that we all understand what this startup system is all about. So I'm Rajiv Bajaj. I have a firm called Bajaj and Bajaj Corporate Chambers. I was part of the Central Council of ICSI, and I was chairman of Northern India Regional Council as well. And since I was working for a long period of time in electronic industry, so I was the vice president of SEMA, which is Consumer Electronics and Appliance Manufacturer Association, so which gave me a lot of traction to understand how the industry works, and how we all and industry association also works. So this is my brief. So we'll be talking about what are the various terms used by VCs and angel investors, and how they look at the startup world. What is their mainstay, and what exactly are they looking at when they look at any startup, and what are their main elements in which they try and discuss, and this is what we are going to discuss in our today's discussion. So first of all, I think most of you understand, but the for those who may not be so familiar how this whole world works, so quickly I'll mention what is venture capital. Venture capital is basically the private or institutional investments which are given to the early stage or startup companies or new ventures, and the people who invest into these companies, they are called VCs. So they are called venture capitalists because they actually invest in those ventures. And so venture involves risk, definitely, we all know that. And they don't have a very certain outcome, so the uncertainty always is there. And the expectation of sizable gain of making money, and also the risk capital is given by none other than the venture capitalist. So when we say risk capital means, then the person who is investing, they also know that we are putting money in a venture where we may not be able to get this money back or recover our money back. But yes, if that venture succeeds, the potential can lead the money becoming 10x or 100x also. So that is where this whole business of investing in startup works, and that is how the venture capitalist, they are looking at the startup ecosystem to put their money into such ventures where risk of losing money is also there if the venture doesn't succeed. But if it succeeds, as I said, the profitability can be huge for them. And the money invested in businesses that are small, because they have a huge potential. The examples can be many: Ola, Uber, and the other startups into e-commerce business, the startups into Zomato, Swiggy. All these are startups. Paytm, Bharat Pay. So we have whole host of startups who have really changed the way people look at the startup ecosystem. And of course, this form of raising capital is popular among new companies or ventures because they need to raise funds. And so how to pitch to these venture capitalists? That's the very important question we all startups should know. So when pitching to a venture capitalist, you need to present the solution which your company is providing to a common problem. So in the all pitch decks, in the beginning itself, there is a problem statement which is discussed. So when you are discussing the problem statement, you are actually bringing out that what solution you are offering for that problem statement, and how you are going to change the world by solving that problem. And accordingly, your business plan and pitch deck is made, and that is where the person who's looking at your organization or person who's looking at your company can make out that what business you are going to do, and how you are going to how your overall traction can be there for the company in which you are as an entrepreneur putting up your pitch to the startup venture capitalist. Now during a pitch meeting, you will present 4 to 5 year projections of your company income and expenses. Your goal is to show venture capitalists the long-term return on investment and how they can mitigate the short-term risk. So this is where you need to work and show your overall traction, because everybody who is putting in money, they are putting in money for multiplying their money. So that's very clear. So you need to actually be very clear about how the returns are going to come. What is the burn rate? Burn rate means how much money you will be losing in the initial phase, and then what will be the return. So that is where the venture capitalist will decide how to look at your company, how much money to put into your company. Now, when you look at the venture capital structure, there is a venture capital firm. There are some limited partners or investors as well, where there can be public pension funds, corporate. Can you mute yourself, please? The corporate pension funds, the insurance companies, high net worth individuals, fund of funds, and then the venture capital funds can be either companies or limited partnership funds. And of course, their main purpose is to do portfolio investment and to put their money into the various startup companies. Who is an angel investor? So this is the venture capital side of it. Now we will try and look into who are the angel investors and what these angel investors mean. Why they are called angel investor in the first place? They are angels because they are risking their capital for the venture in which they are putting in money, right? So the angel investor is known as a private investor, seed investor, or angel funder. Seed means you are in the very initial stage, so they give you the seed money, seed capital, which you require for your organization. So angel investor is typically an individual or a high net worth individual who is an investor who provide funding or financial support for a startup and due of the stake or ownership of the company. So they are looking for, first of all look at your idea, and suppose your idea is so attractive, the solution you are giving to the world is so good that they feel that, okay, I will put say 5% equity in your company against the valuation, whatever you are asking for. So there's always a negotiation, and you can always go for the angel round. And this angel round will definitely give you traction where you can get the money. And the angel investors provide large cash infusion of their own money at the early stage startup, and in return, angel investors receive equity or convertible debt. Now, we already know that there is an instrument called CCPS. Now, this CCPS is basically that convertible instrument, which is given as a debt in the beginning, where the convertibility into equity can be done at a later stage. So this is also one way of investment by the angel investors in your company. And the capital is commonly raised from sometimes family members, friends, and the angel investors are more crucial players in seed financing, and they can provide substantial amount of capital. So the angel investors are very, very important for the scale up of your organization, and that is where you need to look at them. No? So they are very critical for your growth story. So angel investment, you should actually impress on good angel investor, because they are the ones who are initially with you, and they actually participate in the dream which you have, and kind of resonate with your startup dream. So that is what the angel investment is all about. So angel investor may be more interested in your startup idea and team than the immediate potential for profit, because they know, angel investors are aware that their money return will come maybe 4 year, 5 year later. So they are willing to put their money for longer term. They are not looking for immediate profits. They are not the ones who are looking for immediate returns. And but they want the multiplier effect to come to their money, because all investors, they are investing into startups with the intent that they want their money to be doubled or tripled or go 4x, 5x, or whatever. So we have seen people have made 100x money also. So that is the kind of potential which is there in the startup ecosystem, which is not there in the regular stock market. That is why people come from stock market to the startup ecosystem, because they want to make huge money. So that possibility is only there if you are actually putting your money at risk, and that risk can bring in, I should say, disproportionate income as well. So that is where you need to pitch to an angel investor, and what makes your team winning gamble, because and let me tell you, the angel investors are not only looking at you, they are looking at the team which you have. They are looking at the ecosystem you are building. They are looking at the problem you are solving. And you need to present your key business factors, such as your market size, your product and service offerings, your competitors, and their flaws, and if applicable, your current sales, what are you doing, what is your current run rate, and all this can bring some semblance to what you are trying to present to them. Now if you look at this, angel investors are the major the word used is owner, but they are major contributors, who work with your come with your personal relationship, and also they take risk on you. And there are foundations who are actually helping the startup ecosystem. There are funds who are, people are putting money into the funds, and those funds are putting money into the startups. So, and they are giving returns to their, investors. So that is again something which is working very well. And then there are certain hybrid models, which is for-profit and non-profit organizations coming together, and they invest in startup ecosystem. Then there are some early stage VC firms which look at the creative ways to research and meet, they kind of invest on the in the startup ecosystem. And then there are accelerators as well. They have a different focus, and they offer some more than the investment. They offer the mentorship, they offer the direction, they offer the space, they also offer the research and development facility to the startups, so that they can actually get the traction. So accelerators also have a very important role to play, and there are some industry agnostic accelerators, and then there are certain specific accelerators, because every startup has a different need. There are some service oriented startups, there are some manufacturing-based startups. So if it is a manufacturing-based startup, their need for a R&D lab is different than the IT-based startup. So, coming to our today's important discussion, what are the major terms for startups and VCs which are used during the discussion? Because it's very important for all of us to know what are these terms, and we should not be stumped if VC asks a question. We should be aware what these important terms mean, and we should be able to handle their questions effectively. So I thought it is very important that we discuss this topic. And so first of all is ideation. So they may ask, okay, what is your ideation time? So ideation is a process where you are generating ideas or solution through your various brainstorming sessions or prototyping or sketching. And there can be numerous ideas. You need to test those ideas. You need to define your the problem which you are solving. You need to work on your vision and mission statement. We had a session on vision and mission statement as well. And also you need to determine how your product and services will solve that problem. So you need to work on all these things, and this is how we are going to put our problem solving into play. And of course, what is your target market? Target market is basically the group of consumers which your product and services are aimed at. So if you are trying to sell in a Delhi NCR, for example, or you are trying to sell, so geographical target markets are there. For example, if you are into healthcare business, so you are into diabetic care, so the diabetic patients are your target market. So like that, you have different sets of target markets, and how your marketing and sales efforts are going to be focused on, and you need to identify and define this to the customers, how your target market will share the similar characteristics such as various demographic, geolocation, income, lifestyle. All these are part of your target market. Then your startup capital. I think we all understand this. Startup capital is the money you need to start your new company. And of course, the capital can come from your own saving, your friends and family, loans, investments, and various investments we usually receive from the startup ecosystem. VC, we have already discussed. They are the ones who are taking risk at you. The MVP, I think we discussed this term many times. This is the minimum viable product. That means the product which is available to you, where you are able to show to the world what product you are dealing with, what is your mainstay, how this product looks like, and suppose it's a app, then okay, that app itself is a MVP. Like that, you need to have your minimum viable product to show to the world, the investors and the VCs, as to what you are trying to offer to them. And I think that will set the tone for your startup. Then there is a term used, lean startup. Lean startup is a business approach which was coined by Eric Ries, and he mentioned that when you build measures, learn feedback loop by building an MVP to solve a problem, doing test and analysis, and making adjustment or pivots based on the data. You need to actually show to the world that what your startup means. Then comes your very easily understandable term called KPI. key performance indicators. So, when you are talking to the venture capitalist or angel investor, this term may come: what are your KPIs? What are your objectives? And what is the desired level of performance? How you are going to track your progress and performance, and how you are going to, manage your key indicators. What is the decision-making process, and how much conversion rate will be there? What kind of organic traffic you will have on your website, or what kind of number of active users you wish to have on your website, for example. So these are all KPIs which you should be very clear about. And business model itself is, when your company is making profit, you must have the business model in place. You must talk about what kind of overall costs are required to create those solutions which you are working on, and of course how you will attract investment, and how you guide the business operations and develop relationships with the customers. There's another term used these days is SaaS, that is software as a service. So the business model where software is hosted on a cloud infrastructure and licensed to businesses on a subscription basis, that is called the SaaS model. Sometimes VCs ask suddenly, is it a SaaS model? So you need to know what exactly is SaaS. So if it is a software as a service or a license you are selling to your prospective customers, that is called SaaS. And profit margin is very simple to understand. We all know a profit margin is a ratio or a percentage that measures the profitability of the business. And business plan, I think we discussed this many times. The business plan is your roadmap for future. You make a plan where you actually, all the multinationals, I worked with a lot of multinationals, they have a very robust system of making a business plan. And whenever I mentor the SME clients or startup clients, I always say, you must focus on your business plan. This is the most important aspect of running a startup, because if you are very clear on your business plan, and not only you are making business plan, you need to monitor the business plan. So you need to actually month by month, you need to break that into your targets, and then review your monthly achievements with your targets. So that's the most important key element, that you must put your all the market strategies and management acumenship in the plan, and then monitor that plan, and you can take that corrective action. Otherwise, sometimes it happens that you are not looking at your plan and you are just working, and at the end of the year, and that too sometimes 6 months after the year, your accountant makes the profitability sheet and tells you, oh, you made a profit or a loss. That's no way of running business. So you must be very clear about your business plan and make a very robust business plan, and then work on it. So I think that's a very important aspect for running business. Then there is another important term used, which is churn rate. It is basically the cost of acquisition of the customer. Suppose it's a subscription-based model, then when you lose a customer, so the customer lost after acquisition is your churn rate. So that is very important to monitor. I think kindly put yourself on mute, please. And then the proof of concept is basically, we all know, the process of determining the feasibility and viability of business. or design ideas through experimentation is your POC. So you must be very clear on your proof of concept, how you are going to test that. And next term often used is product market fit. Now, this was invented by a startup coach called Mark Andreessen, and he coined this term. Product market fit means being a good market, fit with a product that can satisfy that market. So, so basically, whether your product is fit for the market, and to test that, and you need to create a product and service that provide enough value to the customer. And if your product is good, if you are giving value to your customer, it automatically spreads. So it automatically goes to by word of mouth. You can sell your product, because if there is a one happy customer, he will bring in another 10 happy more customers. So that is where I think you need to keep on experimenting, and you need to keep on making sure that your product needs to be perfectly fit for the market which you are to whom you are offering your product. And of course, you need to churn out good product market fit products. And incubators, we discussed, they are non-profit or for-profit organizations who help startup develop their business ideas and into self-sufficient business. And they provide services such as office space, mentoring, access to investors. There are various incubation programs, and incubator provide entrepreneurs the opportunity to build and test the prototypes to find the right product market fit. So I take a halt here. Of course, we have many other jargons to talk about today. I made a longish presentation so that I can cover all the various aspects. But so far, whatever we have discussed, any questions you have, or any point of discussion, so that we all are on common page. So I'll be happy to take the questions, please.
Rajiv, what's the difference between MVP and product market fit?
MVP is your minimum viable product, which is basically you have to, when suppose you made an app, that app should be visible. One is you are at the ideation stage, you are just saying that I'm going to build that app. But another is you already have a minimum viable product to talk about. You can show the app, you can actually display how this app runs or something. So that is the MVP stage for you. And the product market fit is your product, whatever you are working on, is actually appropriate for the market. When you go and test your product, your what is the feedback of your customer for that product, how they are liking the product, what are the changes they expect in the product, what more can be done to innovate to make it more coming up to the customer expectation. That's the product market fit.
Rajiv, one question is there.
Yeah.
How we can reach out to angel investors, or how we can find it out?
See, there are various consultants also available, and there are various angel investor networks which are also there. For example, there is a Chennai Angel Investor Network. There is a Delhi Angel Investor Network. There are communities. There are various funds who have brought together some angel investors, and they invest jointly. So you need to find out from even internet is full of information of people who are actively into investments, and LinkedIn is another very important source where you can find out who are the active angel investors in your business area. And there are certain sector agnostic angel investors also who invest in all kind of businesses. So this is a tribe which is growing very rapidly. And as I said, that there are certain consultants also who work and coordinate and bridge the gap between angel investors and the entrepreneurs. So what kind of project you have?
Yes, we are thinking about to making a app,
Okay.
matrimonies, etc.
All right. And there are various angel investors. And the matrimony space has many apps, right? So you can find out who are the ones who invested in those apps, right?
Right.
That's the one cue I'm giving you.
Yeah.
Yes, there are certain consultants who can actually help you with this.
Yeah. Thank you. Thank you.
You can discuss offline as well. I'll share my details with you, and we can talk about it.
Sure. Thank you. So nice.
Any other question, Ajish?
Yeah. Thank you, Rajiv. Actually, I have invested in stock market, but in stock market, if it is performing badly, we can exit. But how about this angel investing, Rajiv? We listen to that pitch, and if we give the money to them, like how will we know that it is safe or that kind of things?
Yeah, very good question, Ajish. See, angel investment is, of course, having risk. Now, you are taking a risk on the team. You are taking a risk on the set of people who are actually working on that project, whether they will take good care of your money or not, whether they will follow all the, that money will be put in the right space or not. So that is a very important question, of course. The angel investors, of course, for example, if somebody put money in Paytm or Zomato or the big companies which got listed later, so they already must have got the exit, right? I know certain people who, even without IPO also, they got the exit because there are various series of rounds, right? So angel investment seed round is a very initial investment, right? Then the company may go for Series A, Series B, Series C funding, right? So when the Series A or B funding is happening, it doesn't mean that all the time that funding is so that at that stage also you can exit. For example, you invested into a company at say at a valuation X valuation. Now the Series A may be at 3x, so you have an option to exit at 3x and don't wait for Series B or Series C. But Series B timing, the valuation may go up to 5x or 10x, right? So this is how, if the company progresses, if the company makes money, if the company grows, then angel investors also get exit. But sometimes, but it is not like stock market that you can simply go and sell. You need to have some, either you have to depend on the company itself for finding the exit of your shares, or you need to find a buyer who may be interested in buying those shares instead of you, who may be interested in coming into that company and investing in that company. And that is why angels are called angels, because they take risk on their money. there is a chance that you may lose your money also. So sometimes out of 10 investment people are making, 8 may fail, but those rest of the 2 may give you that kind of return, which will take care of all the investments. So that's how this angel investment works. Yeah.
Thank you, Rajiv. So in Series A, Series B also we can exit.
Yeah, of course,
Yeah.
of course.
Okay.
If somebody else is willing to buy, you can always say that, okay, I want to exit at this level. I don't want to wait for this to become 100x or something. You can sell your share at 10x profit or whatever. So like stock market, no? Stock market also, sometimes that this share may go up, but you want to book your profit and exit. You don't want to wait for and take further risk on that stock. No.
Yeah. And in stock market we have shares, but in angel investment, how will we?
These are also shares.
Okay.
You have equity shares. But there are, as we earlier discussed, there is a instrument called CCPS, where equity comes to you after certain period. No, so 18 months or 2 years or something. So you can also. CCPS is little hard to sell, but the equity is much easy to give it to somebody else.
But how will we know the value in angel investing? Because it's not
see, every round has a valuation, right? So when you put your money, you put your money at a X valuation. Suppose at Series A there'll be Y valuation and like that. So every round has a different valuation. So whatever value that round is on, so you will get the same pricing. So it depends on the.
So who decides the valuation, Rajiv?
There are certified valuers who are available, and the company also, company board also offers that, okay, we are offering our shares at this value. No, so that they are backed by the merchant bankers giving the valuation, and also the certified valuers who are supporting that valuation logically. So there are different ways. So valuation is a very different subject. I think we'll have a discussion on valuation also. I'll bring in some good valuer who will explain to us that how the valuations are done. So that's a good topic for us. Sanjay, I'll surely make that happen. Yeah.
Thank you so much. And there are some companies raising funds even if they're making losses. Is that true?
Yeah, because they say that it is my burn rate. Today I'm making losses, but maybe 5 months down the line or 5 years down the line, I'll give profits, and the people put their money on that promise that, okay, they will make money sometime later. No? So that's how it
So
works.
it is not a requirement that you should be making a profit.
No. Profitability, in any case, people know that in the startups, the initial journey, 2-3 years may be loss-making journey, but later on, all those losses will be wiped off by the future big profits which may come in. Yeah.
This venture capitalists, is it like LIC, mutual funds? Are these called as venture?
No, I mean, LIC is also doing venture funding, but there are different tribes. They actually sometimes gather funds from different sources, and then they put money into the various startups. Some venture capital guys, they don't put money in the very new startups, so they don't give seed capital. They come in at a Series A, Series B only. So like that, every venture capital fund has their own, investment criteria. So that is why sometimes they are called micro VCs. They are VCs who are coming at the initial stage also. but mostly venture capitalists are coming at and putting their money in a company which is maybe 2-3 years old and having some traction to show.
And we also discussed about ideation. So ideation, like to get
ideation is, when you are thinking about your project, you got the idea, but then you are doing your research, you are developing a prototype, you are developing R&D, you are doing R&D, you are creating a sample, you are creating a MVP. So that period is called ideation phase for the startup.
So where can we get knowledge like now these in this area, these things are happening? Any like startupindia.com or about ideation?
Yeah. I mean, Startup India has all the registered startups data. You can go and see who are the new startups which are getting registered, what are the areas they are getting registered. Then there are very many startup related sites which are giving information about what is the latest trend in the startup industry, what are the latest trends in the startup ecosystem. So I think we had a session where we talked about latest trends on where we talked about EVs, agri sector and all. So Government of India also, for example, in this budget, they mentioned that they want to encourage agri-based startups. So like that, a lot of innovation is there in this country. I was in Lucknow to attend this Global Investor Summit, and I met a few interesting startup guys who have a very clear idea of what they want to do. And they have really. I saw a team of youngsters who have created a racing EV car. So they are and they did it on their own. They didn't. They are still not invested by any VC or any, and they have really. It's a bunch of youngsters who came together and they created a fantastic, car which was looking very perfect, racing car. So that's how there are youngsters. I got in touch with the agri-based guy who is working on a model that 10 kind of vegetables can be grown in even the balcony of a house, and they will be providing the support system for doing that to the consumer. So and charging a specific amount for maintaining that, and so they need to invest a very small amount, and they will be getting their own home generated vegetables. So from flower pots, So so people are coming out with a lot of innovative ideas, and those are finding traction also. So that's how it works. Yeah.
Thank you.
Okay, so we move on with our journey to understand all these terms. So let's quickly work on this venture capital jargon. ARPU, average revenue per user. So what is your average revenue per user is often asked. So you must be aware what is the revenue per user you are having. What is your average order value, AOV? I think it's well understood. So what is your order value and how it works? You must be very clear. ARRG ratio, which is average recurring revenue or growth rate, which is something I think we all should be aware of. What is your allocation? That is the size of the round that set aside the specific investor. This is you should be aware in dollar amount also if you are dealing with the global investors. Anchor investor is the first investor of the fund, which can be referred as the lead investor. So when you go for a funding round, the person who's the first investor is called the anchor investor. ARR is the average revenue run rate. This is the revenue of the last month multiplied 12 times. That is how it is considered. Next is a bootstrapping business strategy, which the startup self-finances is called the bootstrapped startup. That means you are using your own fund. You are not using outside funds. A bridge loan or financing is basically the loan given by a startup investor, which serves as a initial fund for the company, and is converted into equity at a later stage. Can be another form of a CCPS. Now look at the cap table. The cap table is basically the official document that shows the capital structure of the company, including the specific ownership level by investor. We, I think, already discussed this, how the cap table looks like. Cliff is an employee stock vesting agreement. Generally have a cliff, usually 1 year before which no employee stock option vest. So it's a kind of a waiting period. Come along rights is called tag along rights, where investor to sell the share if founder or other key employee sells the shares. So this is a clause which is put in normally the investor agreements, where suppose the founder himself wants to sell the equity. So there is a tag along right for the angel investor also to sell along with him. So this is again, Ajish, coming to your question, this tag along right also helps in selling your equity if you put this clause in your shareholding agreement. Control rights are the rights of the investor or shareholder relating to control over the company and its affairs. I think it is very well understood that the control rights are not so difficult to because if you are having an equity, you have that voting power. Now that voting power helps you achieve and get those controlling rights over their equity or over the overall control over the startup. Demand registration rights. This is the right of investor to acquire the company to register because if you are planning to conduct a public offering, at that time these rights come in handy for the investor. Dilution, we all understand. If the subsequent financing round occurs, existing inventor will have a proportionately less equity in the company, so their equity will be diluted. So this is how the dilution happens. Down round is a fundraising round, which is the company is valued lower per share than the previous rounds. For example, the earlier round was say at 100 rupees, but you want to bring it down to 80 rupees the share. So it's a down round because you are offering shares at a discount. That can be because of many reasons. Maybe company is not finding traction. They are hard of getting money. So they may go for down rounds. The employee stock ownership program, ESOP, we all know, it's a pool reserved for future employees for, giving them compensation packages. The exercise price is the amount that must be paid to execute your option. And fiduciary is, how someone who owes special duties for another person who has the liability for non-performing that duty. That's your called fiduciary duties. We all understand this word, how it works. The initial public offering, IPO, we know the process of in which a private company first issues the stocks. Inside round is basically the round for financing entirely composed through the existing investors. So in this round, basically, they don't ask money from outside investors. The existing investors, they put in additional money, and that is how it is called inside round. Issuer, of course, the entity or company that shares represent, they represent the ownership in. And letter of intent is basically like memorandum of understanding, and that's a common agreement between businesses. So potential customer to define commitment, interest, terms, pricing, what are the delivery of goods and services which is going to happen. So that's all is considered part of the letter of intent. LPA is a limited partnership agreement. Usually it's a long agreement where general partnership conditions are put in, and it should be properly drafted. Sometimes these agreements, by virtue of their very small terms, so that is why it is very important to have a proper law firm or a proper professional working on your even SHA, shareholder agreement. Don't make a SHA just like that. You need to have a proper law firm working on it, who can actually guide you and make your SHA foolproof. The memorandum of understanding is common agreement between startups who are pre-product and potential customer defined commitment, interest, terms, and pricing, and how the goods are going to be delivered. So this is MOU is a very well understood word, so I don't think we need to elaborate too much on it. So these words and these jargons are very important because sometimes we kind of miss on it. We are not we are taken off guard also as to what they mean, and you are sitting in the negotiation table, and suddenly some such word pops up, and you are taken off guard. So that should not happen. We all should be aware of these basic jargons which are there in the startup ecosystem, and we must know how we should react to it. Milestone is an event that triggers another investment. That is called milestone. Non-binding, of course, the depth of the legal commitment of the document. So certain clauses are non-binding, so you can always put it that way. No shop clause is basically a term in the term sheet states that the founder, they are not to share the term sheet with other investor in order to receive a competing offer. So they are actually restricted from giving term sheet to some other person. So that is called no shop clause. MF1, most favored nation. I think the anchor investor or largest investor can get all benefits and the side letters from other investors. So sometimes even some restrictive clauses are there that we don't want people from this nationality to be part of this company. So so that is also there in certain cases. So we all need to be aware of this. Participating preferred stock, of course, a class of stock where liquidation, sale, or merger of a company or right in the shares on equal basis is put in. So that is the preferred stocks can be there. Piggyback registration rights, the right of investor to have the shares included in the public offering, where the company plans to conduct for itself or other shareholders. So you need to piggyback on the registration rights of other shareholders. So that is also possible. PPM is a private placement memo, which is a very commonly used term. So, when you make a private placement offer to certain individuals, they may say, okay, what is the PPM? So where is the PPM? So I think you need to be aware that all these terms are very, very important and critical for the overall, understanding for the startup ecosystem. And we all entrepreneurs and the people who are working in this ecosystem should be aware what these terms are, how they are going to impact our discussion with the VCs and the startups. And we should be, not caught off guard if any of these terms are brought in the discussion. So I thought we must concentrate on these terms and try and master these all elements. Any questions further on all this?
Regarding AARN, is it fixed expense?
AARN.
Yeah.
That is, just a minute. Fixed. I have a problem with this.
Like annual revenue expense.
Yeah. No. Annual revenue expense is basically, I think you mentioned RN, no? Average revenue, no? Basically, you take out your average monthly revenue and multiply it by 12. It will give you a 12-month revenue, So for example, you are expecting that your average revenue per month will be this much. So multiplied by 12 will give you the annual revenue.
Okay.
Yeah, it's not fixed expense. It is how you estimate your average revenue for the 12 months.
And this product costing, they give more information importance. So is it something else or?
Product costing is basically your, when you are making your, you are referring to, let me come to this. Product costing is the cost of the product. When you are making your revenue assumptions, you are having the details of the product. You are working on that, right? So what is your product cost, and then based on that, how much is your revenue margin on it, your profitability margin on it, and accordingly you decide your selling price for your product. No? That's how it is. Any other questions? Okay. So I think we discussed up to here. Yeah. So pre-money valuation, we all know the valuation of the company, excluding the capital from current round. Roll-up is basically process used by investors for small companies. Recapitalization is reorganization of company's capital structure. SAFE is another form of a CCPS, which is simple agreement for future equity. So in US, they call it safe notes. So if somebody says, oh, what is the safe note or something, you must be aware safe note is nothing but another form of a CCPS. Side letter is agreement between the fund and the individual investor. TEV is a total enterprise value. this is how the valuation is, worked out. TTM is the trailing 12-month revenue or sum of revenue. Unicorn is a team referring to a startup valued at 1 billion or more. So we all know these days people say that more than 100 unicorns are there in India. So that is how this term came, unicorn, because all these big startups are turning out to be a great, unicorns for, and these unicorns are the ones which are actually, triggering the importance of startup, people coming into startup ecosystem. Valuation, we all understand. Pre-money valuation is how much the company is worth before the angel investor puts in the money. Term sheet, we all understand, non-binding online terms and conditions. Convertible note is basically convertible loan into equity later. Dilution, we have already discussed. I think this is, we have already mentioned. Okay. So I think we have already overshot the time. If we have any other question, I will be happy to answer. Otherwise, we'll just close our today's discussion.
Could you please throw light on vesting?
Vesting is basically, in the ESOP or in certain, agreements to the founders also. Vesting is done for the time they are giving to the startup. So basically, they are vested with the equity after at every stage. For example, every 6 months or every year, as per the vesting agreement or a ESOP agreement, or there is a stock appreciation rights also. This is a new terminology, SARs these days, which is coming in, where SAR is basically the difference between ESOP and SAR is, I'll plan a session on this. This is also a very important, aspect to understand. ESOP is basically when you give equity. SAR is you don't give equity, but you give stock appreciation rights, and you give in cash. You encash that to your employees. So which is based on the kind of equity which is there. So vesting is when that percentage is given. For example, it is said that okay, 2,000 shares will be vested every 6 months. So that's how vesting happens. So total, suppose 10,000 shares have to be given to anybody in the ESOP. So 2,000 given every year or every 6 months. So that can be a vesting.
Can we also say vesting for equity is the same thing?
Sorry. Yeah, they'll be vested in but this is normally used for ESOP or SARs, or ESOP basically. Vesting happens for the ESOPs.
So, for example, I'm introducing a co-founder at a 3% equity, but vested over 3 years period.
Yeah. So that's a vesting.
You are giving equity also.
Yeah, you are giving 1% equity every year.
Every year, yeah.
To make it 3%. So they'll be vested with 1% equity every year.
Every year, yes.
That is what I said, that founders as well as the people who are putting in their time and not charging for that, they normally they have vesting rights. No. So what are the questions which are asked by VCs or investors? One, is there a great team? Is the market opportunity very big? What is your role into the business? How are you different? How much is your company valued at? What is the positive early traction your company which has achieved? Who are the founders passionate and determined? This they make out by asking different set of questions to understand how deeply you understand your company. do the founders understand the key financials and key metrics of their business? So they ask you some financial questions, suddenly ask you some ratios, and suddenly ask you what is your churn rate, burn rate. So all that will definitely become, if you're not spontaneous in answering, they make out that you are not very sure about what you are talking. No, so is the initial investor pitch professional and interesting? Of course, they look at this. What are the potential risk in the business? What is your customer acquisition cost? Why won't you, huge corporation build something like this? So if somebody has a very deep pocket, why can't they get into the same business and do it? So how are you going to be different? That's the normal question which comes. Why hasn't this worked before? So maybe nobody thought about it or something, and how you define success for you and your company, and what is your plan to grow. And you must also always analyze, is there anybody who has actually tested the same idea before and failed? So it should not happen that you are working on the same idea and you think that you are the only one, but already there is a bad example for the same product or same idea in the market. So I think that part you should be very clear, and only then you should move ahead. So I think we already overshot our allocated time today, but I thought this is a very important aspect where we must understand what are the various terms which are asked by VCs and how they look at the startup ecosystem. So any last question today?
Pre-money valuation, Rajiv, is it excluding the capital from the bootstrapping which people have put in, or?
No. Of course, that has to be included. No, pre-money valuation is basically the valuation which is before bringing in the outside capital or the capital from all these people.
But in one of the definitions of written, valuation of company excluding capital from the current round.
Yeah, current round. But your bootstrap money, of course, is already in. So pre-money valuation is not before that.
Okay. Thanks.
All right. Thank you so much, everyone, for joining in today. And we will keep meeting, spreading good message about our community, and let's continue our journey. So today we got 2-3 new ideas of the topics ahead. So we'll definitely talk about them. Thank you so much. Thanks. Bye-bye.
Thank you very much also. And how we can contact to you, sir?
Yeah, I put my connect in the chat window.
Sure. Chat window.
You got it? So you can connect at 98114-53353.
Sure. Thank you, sir.
Right, Deepan. Thank you. Thanks, everyone. Bye-bye. All the best. Bye-bye.
Thank you.
Bye.